Hi, everyone. My name's Ryan Footit. I'm a loan officer at Applied Mortgage, and I've been in this career since 2016. I've closed 383 loans so far in my career, and for a total loan volume of 105 million dollars. And I'm speaking today with Heather Blais. Take it away, Heather.
Hi, so I am Heather Blais with Remax Connections. I am a realtor, obviously, and I specialize with VA, FHA, and conventional buyers. I close about 10 million a year in sales, and typically about 40 units per year. So we both have clients who have a ton of discouragement in the market and a lot of questions about what's happening right now and what's going to happen in the future. So we thought it would be a good idea to sit down and go over what your next steps should be.
Yeah, exactly.
Perfect.
So,
And a lot of my buyers are complaining about the price of houses and how hard it is to get an accepted offer. So that's where you need an expert on your side. The price of houses is higher, but overall, I mean, they're probably still going to go up. And it, I have a lot of buyers who are like, I'm going to rent. Even then, your rent is probably still going to be more than your mortgage. And the appreciation value on a house is so much more valuable and priceless than paying somebody else's mortgage. So that's where we're here to help and work in your best interest.
yeah.
Ryan, I know a lot of people say stuff about the interest rate.
Yeah, so that is, the hot topic in news right now, and what everyone's asking. One of the first questions people ask is, what's the rate going to be? So there's a lot of different factors that impact what interest rates will be for you, your specific scenario. Things like credit score, the loan program you're using, the type of property you're buying, whether it's a primary residence or an investment property, or a single family house or a multifamily house. There's lots of different factors that go into what the interest rate will be. And also, interest rates change every day and sometimes throughout the day. And over this past year, they've ranged from 6.5% to just over 8%. So there's a big range, and rates are very volatile, which means that they change a lot. So they're kind of unprecedented times that, I haven't seen rates fluctuate quite like this in my, career so far. So that's really discouraging to buyers because, they think, well, if I had bought a house 2 years ago, my payment would be a lot less. And that is true. But once you get a mortgage, and once you buy a house and get a mortgage, that's the benefit there, is that you finally got an accepted offer and you own a house. So you're not married to that mortgage for the rest of your life, or for the lifetime of that mortgage term. You can also refinance. So that's something that we're suggesting to people who are buying in this market with interest rates being where they are. If you own the house for a year and now rates are 1% lower, hopefully that's the plea, then you could refinance, and that will save you a lot of money in the lifetime of the loan. So if you're the most important thing when you're getting pre-approved is not getting pre-approved for the maximum amount that you can be pre-approved for. It's getting pre-approved for an amount that you're comfortable making the monthly payments for each month. So that's thinking about your budget and what you're comfortable paying is really my number one tip for when you're thinking about getting pre-approved is think about what you want to spend on a monthly basis. And then we can tailor that payment around a loan amount. And then depending on what you're putting down as a down payment, that'll help Heather, know where to look for a price range to look for houses at.
Yeah, that's a good point. They're not married to the interest rate. So they are a little higher right now, but it ebbs and flows. And right now we're kind of on an uphill climb, but people are saying it is supposed to go down, sooner than later. So, but when it comes to the different types of loans, you're going to need some different amounts of money up front for your down payment and closing costs. Like you said, each scenario is different. Each client's different. It depends on credit score, all of that stuff, and price range of house. So what are people looking at for what should they have up front as a cost?
Cool. So my first question to people is, have you owned a house before? Are you a first-time home buyer? Do you have an idea of kind of the price range you're looking at? And do you have a ballpark of the amount of money that you're planning to use for the down payment? There's a wide variety of down payment, options ranging from 0% down and up. So loan programs like VA and USDA Rural Housing and some first-time homebuyer programs offer 0% down loan program options. And they go up from there. So a regular conventional loan has a minimum down payment of 5% down. FHA loans have a minimum down payment of 3.5% down. And each loan program has its pros and cons, you could say. So the pro of putting a small amount of money down is that you don't have to make a large down payment, and you can either save money or use what you have available to make a down payment and get a mortgage. The benefit of making a larger down payment is that you could avoid needing to pay mortgage insurance. You're going to have a slightly lower loan amount, so your monthly payments are going to be a little less. There's a lot of pros and cons, but everyone's scenario is a little different. So we have a wide variety of loan programs that can fit people's needs.
So is there a way for people to buy down their rate if they have some extra money?
Yeah, there is. And also getting the seller involved too is another way to make that happen. So we have two different programs. One is called a 2-1 buy down, and then we have a 1 buy down as well. So the way that works is that, so for the 2-1 buy down option, you have a 2% reduction in your interest rate for the first year, and then a 1% interest rate reduction in the second year. For the 1 buy down option, there's a 1% reduction for the first year, and then the rate goes back up to where it would be. So the idea behind those is that in 1 year or 2 years, you're going to be paying a lower percentage amount towards your interest payment, and that's going to save you a lot of money. And hopefully by then also you could refinance, so you don't have to have the loan adjust back up to the higher interest rate, where you're going to be spending more on a monthly basis. So those are great programs to use right now where interest rates are, because it can save you a lot of money.
Right. The 2-to-1 buy down sounds like a good option for both sellers and buyers. You're going to see more price drops right now. We're like right on the tip of the iceberg, right between sellers and buyers market. So, the buyers have some power, but not all of it. And the sellers have some power, but not all of it. And with the price drops, a 2-to-1 buy down might seem like a better option to entice a buyer versus offering just, credit at closing to save maybe $50 a month versus, sorry, the dog, versus being able to buy down the rate. You're going to save a significant amount of money and kind of ease yourself into those payments going forward.
Right. Yeah. So it could help out the seller get a good qualified buyer to purchase their house, and it helps out the buyer because they're going to be saving money on a monthly basis for 1 to 2 years. So it really is a great program, and there's a calculation associated with it depending on where interest rates are and what the cost of the house is, how much the people are putting down. So there's different parameters that affect what the actual cost is for that. But if you talk to me about it, I can look into it and do the calculations for you based on your scenario.
So I know different loan programs offer different types of payments, but is there a price difference, or does it affect the price over the life of the loan if you pay monthly versus biweekly?
Yeah, so that's more of a question for your loan servicer. But there's no prepayment penalty on our loans. So that means that you can pay extra, $50 per month or whatever amount you want to pay additional to your monthly payment. Or you could pay the loan off at any time too. If you just hit the lottery and now you have all this money and you want to pay your mortgage off, you can do that anytime. There's no penalty to you. So the benefit of paying slightly more on a monthly basis, or instead of making just one payment per month, making additional payments during that month period, is that you're saving on interest over the lifetime of the loan. So with interest rates where they are, you're going to spend a lot in interest over the lifetime of the loan. And that, that's a scary thing because it's money that's just being spent. It doesn't really do anything. It's just a necessary evil, I guess you could say. But if you pay the loan principal balance off sooner, you're going to save on interest over the lifetime of the loan because you're chipping away at that principal balance faster. And instead of making 360 payments for a 30-year fixed mortgage, maybe you make 300 payments and that saves you 60 months of interest, which is a lot of money. And that's just an example. That's, you could calculate what it would actually be. But yeah, it's a great idea to do that if you want to save some money and you have extra money and you're comfortable making a slightly larger mortgage payment per month.
Right. So I know you mentioned that, different loans require different amounts of down payment. Is there any type of fees associated with not bringing a certain amount of down payment to the table?
Yeah. So, are you talking about closing costs or monthly payment?
Mortgage insurance, like private
Yep.
mortgage insurance?
Right. So if you put down less than 20%, there's some form of mortgage insurance that you have to pay. On a conventional loan, it's called PMI or private mortgage insurance. And it's called private mortgage insurance because there's mortgage insurance companies that we can get quotes from and pay them for your mortgage insurance. It's just like homeowners insurance. Sometimes one company is slightly lower. They have a slightly lower premium than another company. So that's a benefit of shopping between 6 different companies. We can see which one is best on that day. But similarly with interest rates, mortgage insurance is also affected by what type of property you're buying, also credit score, down payment percentage. Those things affect what your mortgage insurance will be on a monthly basis. And mortgage insurance isn't as scary as it was years ago, where it was very, very expensive. It's come down a lot since then, but it's a necessary thing if you put down less than 20%. And so it's called PMI with conventional loans, but with other types of loans, like an FHA loan, it's called a guarantee fee. So it's the factor for mortgage insurance is based on what your down payment percentage is. So for an FHA loan, the minimum down payment for a 1 to 4 unit house is 3.5% down. So if you put 3.5% down, your mortgage insurance factor is that it's just set. There's no shopping around to get a better rate. It just is what it is based on that down payment percentage. And for VA loans, we work a lot with VA buyers together. There's no monthly VA mortgage insurance, but they do have what is called a funding fee that's added on to the loan amount. If you're not if you don't receive any kind of disability award from the VA. And also it's also affected by subsequent use. So if you've had a VA loan before, your funding fee is going to be slightly higher than if you were just a first-time VA buyer. But it's still great because you can make a 0% down payment with a VA loan if you're a veteran and not have to come up with all that money. So it definitely has its benefits.
Right. And that's a great benefit, especially for people who served for us.
Yeah, exactly.
We haven't talked about this before. It just popped in my head. Are there any type of loan programs that you can waive appraisal? Because it is very hard to get an offer accepted against a cash offer. So is there any instance where we can say, hey, Ryan, we don't need appraisal?
Yeah. So appraisals are typically needed for any type of loan program, whether it's conventional, FHA, VA. But we do have this new program called the HomeRun program, where you're essentially making a cash offer. It's a really awesome program, and I think it's going to help a lot of buyers solidify offers. Because if you're competing against someone that's offering a cash offer, the sellers are really, that sounds very good to them because there's no contingencies like there are with a mortgage, someone that's financing the cost of a house. So this will really be a good asset to use to compete against those other cash offers too.
Perfect. So I'm trying to think of what else. So one of the other things that contribute to the amount of money that people need to bring to the table and closing costs would be taxes. So a lot of people ask, will I have to pay taxes on my purchase? And what do they need to know about property taxes and how that affects the sale?
Yeah, so that's a great question. And just one other thing about mortgage insurance before I forget, I
Yep.
kind of skipped over this, but there is a difference in mortgage insurance between PMI and like FHA mortgage insurance, for example. With conventional loans, your mortgage insurance will eventually cancel, so it's not something you pay for the lifetime of the loan. It automatically cancels for a conventional loan once you reach 22% equity, and you can actually have the mortgage insurance canceled if you think you have 20% equity at any point in the loan lifetime, based on the current market value, because that 22% equity, when it automatically falls off, is based on your original appraised value. So as you were saying at the beginning of this conversation, home prices are really appreciating a lot year over year. So that helps people develop more equity sooner, and you could potentially have your mortgage insurance canceled, before it would automatically fall off. Whereas with an FHA loan, you pay mortgage insurance for the lifetime of the loan. So that means until you pay off the house, sell the house, or refinance, unless you put 10% or more down. If you put at least 10% down, then the mortgage insurance cancels after 11 years.
Okay. Is that because it's a government funded loan?
Exactly. Right. That's just a stipulation you can with the FHA loans.
Perfect.
I just didn't want to skip over that because that's an important part. But you brought up real estate taxes. So
Yeah.
real estate taxes are an important thing to consider when you're thinking about what towns you want to buy in, because every town and city has slightly different real estate tax rates. And that's going to affect what you pay on a yearly basis, which affects what you pay on a monthly basis. And as a mortgage loan officer, we're concerned in what you pay on a monthly basis for what you qualify for. So if you look at one house in one town that has higher real estate taxes, it might limit what you can afford in that town. But if you look at the same property value in a different town with lower taxes, you might be able to actually get pre-approved for that house. And it can also make your monthly payment more comfortable for you too, because it's going to be lower in the towns that have lower real estate taxes.
Right. And how does that affect the amount of money that they have to bring to closing then?
Yeah, so that affects the closing costs and prepaid items as well, because there's for your closing costs, we have to get your escrow account set up for real estate taxes and homeowners insurance. So if your taxes are on the higher side, that's going to increase what you actually need to bring to the closing for your closing costs. And then there's also the prepaid side of real estate taxes and homeowners insurance too. So you pay for the first 12 months of homeowners insurance at or before the closing date, and then you pay whatever is due. If there's a tax bill that's due within a certain amount of time after your closing date, you have to pay that tax bill as well. Okay. So that's it's more so about timing, but really the big thing is what the real estate taxes are for the town or city that you're interested in buying in. So that way I can come up with an accurate estimate for you on what your payment will be and what you'll need to bring to closing for closing costs and prepaid items.
Right. So a lot of my sellers and buyers, like we said, they're just concerned about the market and they keep saying it's a bad time to buy. My look is there's no bad time to buy. It's a good time to buy no matter what, because you aren't married to the terms, you aren't married to that rate, and you can always go and refinance if there's a better rate out there. Is there any time that refinancing, is there too soon to refinance? Let's put it that way.
So that's a great question. So there typically you have to wait at least 10 periods. So when I tell my customers that I'm working with, they ask, when can I refinance? I typically tell them you need to wait at least a year, because there is a minimum amount of payments that you need to make before you can refinance. But there's other programs too that might allow that timeline to be expedited too. Sometimes lenders will offer, if you buy within this certain time range, then you can refinance without having to pay certain closing costs. So there are some benefits of doing it sooner than a year too, if it's allowable.
Right. Is there anything else you can think of to let people know of, or any questions that you're getting on your end that you want addressed?
Yeah, so something that people ask about too is, do I need to work with an attorney? So the term attorney is that's how it's used in Massachusetts and typically in Connecticut, but in some other states like New Hampshire and Florida, for example, they use what is called a title agency or a title company. They're essentially the same thing. They are doing the same kind of services for you, but they're a really important part of the process. And it's important to work with an attorney that your lender and your realtor know and trust, because if you can work as a team who work together all the time, it really makes for a well-oiled machine, and it just works very efficiently. So that's, talk to your lender and talk to your realtor on who they suggest you should work with as your attorney. But they do a lot of like the behind the scenes tasks that are required to make sure that you're buying a house without any liens on the property, or you're buying it free and clear. And they're also going to do things like the survey or plot plan for the property, so you know exactly what you're buying, as far as like the actual schematics for the lots. And they also review all your documents and things too. So they're making sure that you're doing everything in your best interest and everything is by the book. So it's an important part of the process. And we don't have what's called a closed attorney list. So that means that you can work with whoever you want to work with. And if they're not on our approved attorney list, we can get them on the approved attorney list. And it doesn't cost anything to do that. We just have to know who you want to work with, and they just provide us with some information to complete the attorney approval process.
Perfect. Yeah, like you said, there's a lot of moving parts. So making sure that you find somebody who knows what they're doing, um, on the lending side, on the real estate side, and on the legal side, that's very important. And also insurance is a huge moving part in all of this. You need a home insurance binder. And I'm getting complaints that the price of homeowners insurance has gone up, which also it raises your closing costs, correct?
Yeah, that's correct. That's we have a mutual friend who's an insurance agent, excellent. And she was letting me know, insurance is a lot more expensive than it was before. So that's important when you're coming up with numbers, because sometimes it takes people a long time to find a house and get an accepted offer. So it's important when you're getting estimates from your lender and you're getting pre-approved for a certain amount, that they're factoring in the correct numbers to make sure that, all right, your payment's going to be X per month. And then you find out that your insurance is $50 more expensive than they were estimating. That can make a big difference if your debt to income ratio is tight. So it can affect what your monthly payment will be, and it can also affects what you can qualify for. And it can also affect what your total closing costs on the loan will be too, because like I said, we collect that first year of homeowners insurance on or before the closing date. So that just could change what you'll need to have ready for the closing costs.
Right. Absolutely. Yeah, I mean, the biggest takeaway I'd like people to get out of this is don't be scared of the market. I mean, I don't see it. Everyone keeps saying the bubble's going to burst. I don't think it's going to burst. Again, this is a personal opinion. I think we're going to be at a plateau for a while. And even if the interest rates go down, the cost of homes are still going to go up. So it's going to even out eventually. I would say buy if you're ready. Find somebody who knows what they're doing. Find somebody who's knowledgeable in the real estate part, and making sure that you're pre-approved before you go and you're fully ammoed with what that loan means, what your costs are going to be, and no pulling credit while you are in that process. That has happened too many times. No buying that Ferrari before we close.
Exactly. Or furniture for the house, anything like that. You don't want to open up any new lines of credit. It's very, very important.
And don't max out your lines of credit either.
Yeah. Talk to your lender before you do anything like that.
Absolutely. But I would say you're not married to the rates, and it is a good time to buy. I mean, the inventory is low, but it's in high demand. I will say that. And there are people who are going to buy, and you know, the price of rent is going up. You're honestly paying for somebody else's mortgage. And I am a huge advocate for investment properties. So if I have a buyer, I have a ton of buyers right now buying two families. They'll live in one unit, rent out the other. And it's a good way to kind of offset your mortgage a little bit. And you also do multifamilies, Ryan, as well,
Yes.
correct?
Yep. 1 to 4 unit owner occupied or investment properties. And I actually did that for my first house too. And you know, it's awesome owning a 2-family house. It
Yep.
helped me live essentially for free by getting the rental property or rental income rather. So it's great for someone to do that, you know, is willing to do that. I had
Yeah,
a
it's
great
nice
experience
that
with
you have enough experience professionally, but also personally, you've done it.
it. Hmm.
And I do suggest it for some of my clients who, you know, like you said, that DTI is a little tight and they're a little worried about what their mortgage is going to be, or they're worried about making those payments. Having a tenant in there could be an offset to some of that payment. Again, you have to talk to legal counsel on that. I would always suggest having a written lease in there, but um, definitely talk to an attorney if you decide to go that route, and make sure that you are protected, your tenant's protected, because there's a lot that goes into being a landlord.
Yes, for sure. And just touching on your, you know, the rent and everything too. So that rent, the projected rent for that property, we can use up to 75% of that projected rent to help increase your, you know, the qualifying income that we're using for you to help you qualify for a more expensive property. Because we're offsetting some of that payment with the rental income that you're going to receive in the future.
That's awesome. And you can actually buy multifamilies, like you said, up to 4 units with a VA, FHA, or conventional loan. So
Correct.
it does give a widespread option to people in different scenarios.
Yep, exactly. Yeah. FHA is as little as 3.5% down. You could buy a 1 to 4 unit house. And with VA loans, you could buy one with 0% down. So it really is there are a lot of options to help people get into multifamily houses like that.
Yes. So hopefully this was a good conversation piece for everybody, and at least you took something away from this. Please feel free to reach out to me personally. My information is going to be on this post. So, and Ryan too.
Yeah, please.
Great resource. My personal lender as well. He is a great person inside and out, and professionally too. He's definitely an expert and one of the good ones. So, and like you said, you're always coming up with new products, and you have new products coming in to help give that one up to the buyer in this market. Again, sorry for the watchdog.
He disagrees with you.
He disagrees with me. But thank you for joining me on this, Ryan. It was really informative. I learned stuff, of course, and hopefully we helped somebody out there with this.
Yeah, let us know if you have any questions. We're always available, and we'd love to help you.
Yes, absolutely. You guys have a great day.
All right, thanks. Talk to you soon, Heather.
Bye.